You may recall from our last video the important and central role played by banks in our modern lives. You may also now know how a typical bank makes its money. Feel free to check Transfin's YouTube channel for more. But the bank that you deal with on a day-to-day basis, i.e. for depositing your money and for borrowing, is one of the many different types of banks out there. So today we will try to understand what other types of banking institutions are out there and how do they work. First is the most common variant, the retail bank, which collects deposits and makes loans to retail customers, or in plain speak, to individual people. Many banks in India term their retail banking operations as personal banking. Besides deposits and loans, retail banks provide ancillary products such as credit cards, forex, locker facilities, and investment products such as mutual funds and insurance. Second is corporate banks. Think of corporate banks as retail banks but for companies. Corporate banks create current accounts as well as cater to corporates' borrowing requirements. Corporate banks also look into specialist needs such as working capital loans, export credit, lease financing, and obviously the old-fashioned loan. Average ticket size is obviously higher for corporate banks than for a retail bank. However, the underlying risk is in general considered lower than that for an individual, which explains why companies usually get cheaper loans versus people. Third is development banks, which serve the same function as a corporate bank but only focus on financing specific types of projects, aiming to generate economic growth and social change. As such projects have a longer gestation period, development banks have a more relaxed repayment schedule. They are often associated with NGOs and may specialize in providing or encouraging microfinance. Rich people often manage their money via institutions called private banks. These banks don't lend themselves but only act as asset gatherers. They advise and invest money on behalf of rich people and make a commission or fee for their services. The largest private banks are domiciled in tax-advantaged economies with strong banking secrecy laws such as Switzerland. You may have heard that a lot of Indians are evading their taxes by parking their money abroad. This money is locked mostly in private banks. Investment banks are those that principally provide capital market services such as sales and trading of shares and other financial securities, as well as advisory service to big corporate clients while they are undergoing mergers and acquisitions. Investment banks also underwrite shares of companies getting listed on the stock market. Underwriting is akin to stamping a guarantee that the investment bank will sell a certain amount of newly issued shares above a certain price, or otherwise end up buying them themselves. Underwriting gives investors comfort that the shares are backed by an established institution such as a bank. Then you have universal banks, which provide most or all of the banking services described above. Not all countries allow universal banks, as regulators often suspect them of conflict of interest. However, in India, the universal bank model is allowed, thereby explaining why most banks here offer the above services in one form or the other. Hope you're clearer now and have enjoyed this video. Our next episode is going to take a deep dive into the world of non-performing assets, or NPAs, which pose a huge headwind on the Indian banking sector. Please comment and subscribe to Transfin for receiving rich original news content from the world of business, finance, and our economy. Have a great day.